Hello, Finimizers. Welcome to another Finimize Live. It's our first one of the year. My name's Russell, Global Analyst here at Finimize, and I'm happy to host today's event on your 2026 investment playbook with our partner, Charles Schwab. Okay, so let's get started. Today's session is brought to you in partnership with Charles Schwab. If you're not familiar with Charles Schwab, the firm believes in the power of investing to help individuals create a better tomorrow. It has a history of challenging the status quo, innovating in ways that benefit investors and the advisors and employees who serve them, and championing their clients' goals with passion and integrity. You can find out more in the link in the chat. Now, of course, no finance event is complete without a quick disclaimer. Your capital is at risk. This isn't financial advice. Tax treatment depends on your individual circumstances and may be subject to change. With that out of the way, I'm really pleased to introduce today's guests. We are joined by not one, but two members of the Charles Schwab team. Kevin Gordon, who's head of macro research and strategy, and Richard Flynn, managing director, Charles Schwab UK. Kevin is the research associate for Schwab's chief investment strategist, Liz Ann Saunders. In addition to analysing the US economy and stock market for Schwab's clients, he helps develop deep dive projects as well as content for Schwab's public website, internal business partners, and social media outlets. Richard is an experienced financial professional with over 20 years of experience in equity markets, specializing in US investing and the delivery of financial advice. He's been with Charles Schwab for over 14 years, and for the last 6 years has served as chief executive of its UK retail business, Charles Schwab UK. It's a real pleasure to have you both here today. How are you doing? Oh, we've even got Richard live, even better. Fantastic, yeah?
Hey, Russell, thanks for having us.
Cool. You'll see a poll on the screen. What's most important to you when choosing a firm for US investing? There's a rank from 1 to 6, with 1 being most important and 6 being least important. Please let us know what is most important to you. Okay, Finimizers, so let's dive in. First up, Richard, why should investors use Charles Schwab to invest and trade in US stocks?
Yeah, well, I mean, there are countless options out there in the market these days, and it's something that we welcome. I think our business was founded in 1973, and we've been through 50 years of markets. We have a lot of experience in handling the typical issues that retail investors and traders have. And when I speak to people who are looking to access the markets, they're looking for predominantly low fees because the impact on their returns is significant over time. They're looking for quality service, and I think that's something that's really important. The ability to speak to somebody if you have an issue, if you have a question about a trade that you want to place or a strategy that you want to embark upon. Having access to professionals who you can talk to is a really important thing, particularly in the modern world where there are a lot of fintechs that work through chatbots. And then lastly, research. I think the ability to help you make investment decisions is a really important part of what being a brokerage is about. And all of those things are really central to Schwab's business model. So in summary, really, low fees, great service and great research. That's what I would guide when telling people who to choose to trade through.
Great reasons, thanks. Okay, Kevin, what are some of the most important reasons to invest in the US?
Hey Russell, and thanks for having us again. So I think when it comes to investing in the U.S., clearly there is a little bit of a bias when you look at U.S. market indexes like the S&P 500 in terms of the tech and the tech-like parts of the market, whether it's tech itself as a sector or communication services, and to some extent consumer discretionary. I mean, I know this was a theme that we touched on last year, and you look at the dominance of those sectors over the past year, and they have remained quite dominant, and they've grown increasingly powerful in terms of how much they sway the index. But we also know how much that can work in the opposite direction. We're certainly learning that on a day like today. So I think the one benefit that we've seen is not only how much those have become really powerful drivers of the market over the past several years, not just the past year, but in terms of what I think is the most dominant theme still today, everything related to artificial intelligence. There really has been more of a spreading out, across multiple sectors. I would argue every single sector in the S&P 500, and that's where we find, there's still a lot of benefit in the United States in terms of how many companies and industries are becoming more in that AI adopter category, as opposed to just having to rely on the hyperscalers and the large mega caps that have been driving a considerable portion of not just the returns, but also just the overall investment. So there has been a little bit more of a leveling of the playing field, and we're very much learning, quickly this year so far, just in the short time that we've been in 2026, we're learning that, other parts of the equity market in the US can work well, evidenced by the move that you've seen in small caps, evidenced by the move you've seen in some of the deeper cyclicals, even the energy sector which was sort of left for dead in 2025. So I think that leveling of the playing field has shown that the US is still it's remained a relatively solid place to invest for investors.
Okay, thanks for that. Yeah. Okay, Richard. As commissions and trading fees on Charles Schwab are actually zero, investors can choose as many stocks as they like to build a portfolio. How many stocks do you recommend an investor should have?
Well, every investor is different. That's a really important, consideration. And you have to factor in how much time that you have. We work with a lot of very, very busy professionals, and I equate having an investment portfolio to having a garden. You have to look after it. You have to make sure you take out the weeds and you plant in time, in the right way. And if you consider that, obviously there is a risk or a tendency that with $0 trading commissions, people can buy nearly too many positions to be able to monitor and effectively manage. Modern portfolio theory would dictate that you typically don't have more than 5% in any one holding. So on that basis, you'd certainly look to have no fewer than kind of 20 positions typically. And anywhere between 20 and 40 is a relatively manageable number. When you go above that, you begin holding very, very small percentages of your portfolio in individual stocks, and you really wonder, well, is the benefit really there for me from this investment? And can I manage and monitor the stocks effectively, given the level of time or effort that you're able to put into managing your portfolio? So for a typical investor to be able to diversify across sectors and to manage their portfolio, I'd say anywhere between 20 and 40, Russell.
Okay, great answer. Thanks. So Kevin, what are the biggest risks for investing in US stocks, and are they different from investing in other countries?
Sure. So, when we run our outlook for 2026, one of the big themes and really the central theme was around this notion of instability. Everybody's been using the alphabet to try to characterize the U.S. economy. You often hear, K thrown out there. You hear U, a U-shaped recovery. Where it takes a lot longer for us to get back to what is thought of as normal. And we kind of threw out the letter I, which stands for instability. And there's an important, I think, distinction between instability and uncertainty. You often hear about the economy and the market facing a lot of uncertainty. Instability doesn't necessarily imply that you can't see things, because I think, we could argue that we certainly see a lot of what's going on in the world, and certainly within, U.S. policy, especially that coming from Washington and from the White House. So for us, it's figuring out how to manage through and get through, I think, this more secular era of more geopolitical instability, in particular, market activity and economic activity that's driven more by just policy coming from the White House. And I think a way to think about that is, even if you just look at US GDP as an example, last year in the first half of 2025, you had a record in the first quarter and the second quarter, but opposite directions. You had a record share of US activity and economic growth being driven just by the trade component. So when we look at imports relative to exports, that's how much was being driven by just activity related to tariffs. And then, of course, we knew what the market impacts were in April, and then the significant bounce after. So our theme from 25 in terms of us being an unstable environment hasn't really changed going into 26. But as Richard was talking about, in terms of diversification, it often sounds like a boring answer and a boring thing to talk about, but it really is the best tool to sort of navigate, through that instability and to kind of hedge against it, lowercase h, hedge against it. And we think that continues to be, a relatively solid way for investors to deal with this. And when you think about international markets in particular, the weakness in the dollar last year was a significant contributor to gains around the world outside the US. We really haven't seen any signs of material pickup in the dollar this year. So as long as that stays the case, you still have growth prospects looking up, in certain parts of the world, especially parts of Europe, then you can continue to see that diversification working in your favor, especially if you're just looking within the equity market. So I think that's something that's important to remember, especially because, again, in the short year so far in 2026, we've seen, quite a fair amount of instability when it comes to everything related to Venezuela, and then now, of course, everything that's going on with Greenland.
Okay, thanks. And then with all of that in mind, which stocks and sectors do you think look attractive for 2026 and why?
Yeah, so our formal sector ratings, we still have outperforms on communication services and healthcare. Those rank, at the top. The important one that always gets a lot of a lot of attention is tech, which we brought back to just market perform or neutral. You can think about it that way. Where we just thought that a lot of that exhaustion in the AI trade, especially within the hyperscalers, got a little bit stretched to the upside. And for the most part, I'll have to knock on whatever I can, but that's worked relatively well in terms of tech broadly being unchanged over the past 5 to 6 months. So it's been more about this rotation in leadership. Number one, to areas of the market that just haven't done as well over the past year. I think that's a little bit more driven by sentiment being, pretty pessimistic, pretty dour on those areas. But number two, I think again to what I was speaking of at the beginning in the first answer, more of this broadening out in terms of AI beneficiaries now starting to see a little bit more, impacts in a positive way to their bottom lines. And I think that the clearest way to see that is within the small cap space within the US, where you're finally starting to see earnings estimates for those companies turn a little bit higher. But there's also, sector biases that are working in favor there. Healthcare is a huge component of the Russell 2000. That's the proxy for small caps in the US. So if you think about those sectors continuing to do well, it would accrue to the benefit more of small caps relative to large caps. So that's just an example of how some of those sector dynamics, impact one particular asset class disproportionately relative to another.
Okay, great. Thanks. Richard, what do you think are the best ways for investors to find winning stocks? And maybe it could tie in with screening tools that, Charles Schwab have.
Yeah, well, I mean, the amount of information out there, Russell, is just incredible. You'll be able to find out all of the publicly available information about any company immediately using our platform or most platforms, frankly. It's a relatively homogeneous access of information. If you go on, Yahoo Finance, you can get the updated financials for any listed company. One of the things that we have to help people make investment decisions is a tool called the Schwab Equity Ratings tool. And you can run filters, obviously, through different sectors or looking at different criteria, depending on the size of the company. If you're looking for large cap or mega cap, et cetera. If you're looking for companies with strong cash flows or good PE ratios, for example, you can screen for those very, very easily to all of a sudden, if you consider you want to make a decision about energy and you want to look for a strong stock within the energy sector, well, you can use what you feel is an indicator of a good company or a good stock. And then you can filter in that screening, the Schwab Equity Ratings filter. And that is something which we have run since 2002. It's a methodology that uses data to create a rating. So it's not sentiment driven as an analyst's view might be. It's very, very methodological. And one of the things that it provides is a bell curve rating of A to F, with A being a strong buy, F being a strong sell. A lot of sell side analysts, for example, have very few sell ratings, but our methodology allows for a bell curve. So you can identify the A and B rated stocks, which would be buys or strong buys in that particular sector. And all of a sudden, let's say you're looking at energy, you might start with 300 companies, but using selective filters, you're then able to actually make a decision out of 3 or 4 that meet your criteria. So the difficulty with investing, with how many stocks there are in the world, in the universe available to investors, is that there are too many to make a valid decision knowing everything about every company. So for an investor to be able to make a rational decision about which stock is likely to fit in their portfolio and offer them a chance of success, you have to use those filters and screening tools very carefully.
Excellent. Sounds like a great tool. I may have a go at it myself later or
Good.
tomorrow. Okay, one more before we move on to the general Q&A. So please sort of remember to put your questions in there. Yeah. In the UK, there's the Financial Services Compensation Scheme, and that provides protection for individuals up to £120,000. What protection exists for clients holding funds with Charles Schwab in the US?
Yes, very, very common question. The best way to think about this in terms of the protections for investors, not just in the US, but globally using Schwab's platform, is that there are a number of safety nets which sit underneath your assets. First and most importantly are the broker-dealer segregation rules. So Charles Schwab, as a broker-dealer, has to keep client assets separate and segregated from the business assets. So if the business, for whatever reason, ever finds itself in difficulty, those assets are ring fenced and returned to clients, and they effectively cannot commingle at all with the assets of the company. So, that's a very, very important thing. If you look at the institutions that failed historically, there were typically proprietary trading firms that were trading off their own book, and the assets weren't commingled, or sorry, were commingled. They were separate. They weren't segregated from the assets of the company, which is why when the company failed, people lost their money. We do have SIPC insurance. That's a very, very important level of cover, the Securities Investor Protection Corporation. So Schwab is a member firm of SIPC, which protects clients for up to $500,000 of securities or $250,000 of cash in the event of any fraudulent activity that leads to the liquidation of the firm. However, that's probably the third or fourth safety net in terms of the protections that the US market provides for UK retail, or US retail investors, and UK or indeed global retail investors. But the broker-dealer segregation rules by far are the most important level of protection that applies to investors accessing the US market. And indeed, the US one with the amount that's mentioned, 120,000 and FSCS, that is an important element. But again, the reality is that there are protections in place prior to the activation of those FSCS schemes as well in the UK.
Okay, great. So, okay, please, the questions, I see some coming in for Kevin and Richard. Have a look, and please don't forget to upvote the questions you're interested in hearing, just so they'll get answered first. Okay, can we have a quick look at the poll result? Are you there, Seb? Cool. Okay. Low fees and commissions. Well, zero kind of wins the game there, doesn't it? Yeah. So yeah, you're at the top of the list on that, and you can read through the
Love to
answers.
see that.
Okay, let's take it from the top because that's it. I suppose this is more for like, how do I get involved? Top question there, yeah. I suppose it's setting up accounts is what it's referring to,
Oh yeah,
yes.
yeah, very easy. So if you're in the UK or indeed in most countries globally, if you simply go to schwab.com, and it should redirect you to either the UK site or international site or one of our Asian sites, there's an open an account button at the top, which if you click through will take you through to our account opening portal. You have to upload a little bit of ID. As you can imagine, for most financial accounts, you have to give us your information. Takes about 5 to 10 minutes to go through that process, and then once we've received everything, we process the account opening and contact you to let you know once it's open, up and running, and then you can simply send across whatever you would like to start off the investing journey. We have a $0 minimum. We used to have a much higher minimum, but we dropped that to zero a couple of years ago because our goal is to democratize investing and to ensure that as many people can access the US markets as possible. And in addition, then as soon as you start, we will give you a call. You'll have an introduction call from one of our team to help you understand how best to use the tools and how to fly the plane, and then you're up and running. So it's hopefully a very quick and smooth online onboarding experience. But you do have a 24-hour service available to you. I could see that was relatively low down on the list of requirements, but once people start trading, that actually increases. I'll tell you that much. So, having that ability to speak to someone 24 hours a day on a free phone number is incredibly helpful.
And is there an app? That was a quick follow-up that kind of sneakily
Yep.
got in there. Okay,
Absolutely.
good.
People can trade through the desktop, through the app, over the phone. We still indeed have our telebroker service. So if you did want to punch in a ticker symbol using an old school landline, you can do that as well. But the app is very, very user-friendly, fantastic interface, and you're able to trade through the app and pretty much run your account from your pocket.
I'm going to scroll down just a few to because it's been upvoted. Yeah. What are your suggestions for retail investors to utilize AI for stock analysis by sector or individual companies?
I mean, I don't know, maybe I'll go first, Richard, and then
Thanks,
if you
Kevin.
want to. I just, I think, well, first of all, there's so many tools out there now. I think, and I often reflect a lot when I get this question on how I use it in my workflow, just given all the data that I'm sifting through on a daily basis. The biggest thing is just to make sure that you verify and make sure that you're fact checking and you're not, any tool that you're using is not, pulling from a source that's not accurate or, that's giving you the full summary. Context really matters in markets and economics. And so I think that really becomes an important feature when you're using any tool. So that's my biggest thing, especially because we're still so new in how much this is really going to impact our daily lives, especially when it comes to investing. I mean, I think it's one thing for helping you summarize a book or a novel that you're reading. It's entirely different when you're talking about your financial life. And you still want to be able to work with that, work through that with somebody, I think probably preferably as you grow in your financial future who's live, not just a bot to help you through it. Of course, that's useful, but I don't necessarily view that as a replacement for any industry. It's kind of my broader thoughts on AI. I don't think it's a replacement of people or jobs. I think it's mostly a replacement of certain tasks. So that's my 2 cents. But Richard, anything you want to add?
What I would say is pretty much exactly what you said, Kevin. I think, as we consider, like any company, how best to use AI within our business, one of the phrases that keeps coming back is augmented intelligence rather than artificial intelligence. It should add to your research. It shouldn't replace it. And that's a really important thing. So do consider the data sources, as Kevin said. Too often I've used AI and been frustrated just by the hallucinations or the inaccuracies that come back. And it does make you think twice. And it is getting better, obviously, and it will get a lot better and more reliable. But for now, just let it, augment your own research rather than do all the work for you. I think that's the key message at this stage of AI's journey.
Okay, good, thanks. Okay, next one. What do you think are the most underlooked areas or arguably best opportunities for 2026 for investors?
I mean, I still think that, I mentioned small caps and their profitability outlook having improved. I still think that what has kind of gotten a little bit skewed in the past year was this anytime you would see a rally in small caps last year, most of the time it was actually in favor of the low quality, unprofitable small caps. And that was at times, we were having sort of these, frenzy moments where low quality parts of the market were outperforming for whatever reason. But we still think that with the high quality parts of small caps looking relatively strong in terms of profitability, that's probably still an underloved trade, especially because you think about from a sentiment standpoint and how many outflows that we saw across the index universe for small caps. If you were to look at it just on a calendar year basis, 2025 was one of the worst years for small cap flows. That actually tends to work in favor. Of course, there are other things at play, but that tends to work in favor of any asset class when you see that pessimistic of a sentiment gauge in terms of actual money leaving that space. Yet the profitability, outlook looking like it does now, where forward earnings estimates are actually starting to turn. So it's not to say that investors should just go all in on small caps and dump everything large caps. I think Wall Street often thinks in those terms where it's all or nothing, or it's this asset class or that asset class. From our perspective, and again, it'll depend on whatever someone's portfolio looks like and what their risk tolerance is, but that sort of argues in favor of maybe adding to a portion of your portfolio that has been ignoring small caps or that has seen that portion diminish over time. Same thing on the opposite side of the spectrum when we think about larger parts of the market, large caps getting increasingly expensive, and if investors feel some consternation around valuation risk there's nothing wrong with taking a little bit of profits and adding into areas that haven't been doing as well, but that still look relatively healthy. So it works in both ways.
Okay, thanks. I'm going to scroll down just a couple again, just if you're following. There's a question from Lawrence. Are you able to comment on the correlation or lack thereof between instability, uncertainty in the market, and the number of stocks one should keep to look in their portfolio? Still that 20 to 40 that you mentioned before, or more or less to hedge against uncertainty, back your winners more, you know?
I think one of the most important things is you know regular rebalancing. I think that's a very, very important part of managing a portfolio. And it's very easy with outperforming stocks to find yourself a little imbalanced. And considering, and again, everything is individual. I think that the risk appetite, the approach to money, the outline, the timeline, what people are actually looking to achieve from their portfolio. And that's a key question very few people ask. What am I looking to get from this? Is there an end date for my investing? What target, performance am I looking for on an annual basis, or in 10 years time, 20 years time? What do I want to get from this? And so, managing, like I said, I've always liked the analogy of a garden, because it can very easily become overrun. It's very time consuming to manage and to look after, but it can be worth it in the end. You can have the garden that you want to have. I do think 20 to 40 is a sensible number if you are looking at stock-based portfolio. But bear in mind, there should also be asset class diversification in there as well, to protect risk and to manage the balance of all of the instability that we talked about. If you look at, for example, the outperformance of gold in recent times, if you look at the fixed income bond markets, you look at that relative to arguably the overvaluation of some of the large cap stocks, which take up a lot of noise and have a lot of attention on a daily basis. I think there is a way to manage risk and to manage your own personal expectation of how to manage your portfolio. And frankly, unfortunately, the answer is good investing is pretty boring. It should be boring. It should be relatively steady, and not to get distracted by a lot of the noise that's taken place around us now, which has always existed in one form or another, as long as people have been investing, certainly since Chuck Schwab set this company up in 73.
To that latter point you were making, Richard, just one thing, and to put a data point on it to show how sometimes the boring is actually more exciting. If you look at calendar year 2025, and I'll preface this with that I don't cover individual stocks. This is not going to be a recommendation in either direction. But if you look at full year calendar 2025, the largest contributor to the S&P 500's gain in terms of the percentage point contribution was Nvidia, just by virtue of its size, because it's grown to become the largest stock in the index. If you were ranking its performance, just its percentage performance in 25, it was ranked number 75. So that means 74 companies in the index outperformed Nvidia and had better performance. Not to say that Nvidia is a good or a bad company. That's really to say nothing about it. But it's just looking at that difference in the conflating that people often do between the largest companies being the best performers. Not always the case. We're especially seeing that year to date so far, where the Mag 7 have really become the Lag 7. They're just really not doing well relative to the market. Again, not a recommendation or to think about it in good or bad terms, just to show that there are other exciting companies and industries when it comes to performance.
Okay,
and actually, just to jump on that as well, very quickly, something that I remember learning a long time ago, that there is a distinction between a good company and a good stock. A good company can make great products. It could have a great, place in the market. Again, not talking specifically about individual companies, but let's look at Peloton, for example. Great product, really nailed it back in the pandemic. As an investment, there were issues with that company that led to a lot of people probably getting their fingers burnt with that. And so one thing I would urge caution on is people buying stocks because they just like the company. Look into it more in terms of the valuation, the historic performance, the fundamentals, the sentiment around the stock itself, rather than, hey, that company makes a great product, I should buy some stock in it.
Okay, good. Look, we're running out of time, but I want to get one question in because it's been upvoted a few times, and it's quite an exciting one. So one of the sectors is, in terms of sectors, what do we think about energy, mining, and space?
Oh my. Mining and space. We cover energy, broadly in the S&P 500. Mining and space, we don't really cover. Space would be interesting. Energy, we're not as excited about energy just because of the prospect for oil, global oil prices to stay relatively low and remain under pressure. There's not enough, I think, working in favor of the energy market in terms of demand really coming back online. Even if in this whole Venezuela situation, you were able to extract a lot of that oil supply, refine it, and then send it out into the world, that would even add more to the supply glut that we see around the world. So, I don't think that would be a recipe for prices continuing to rise. To me, the spike that we've seen in energy so far, as to what I discussed earlier about just sentiment kind of getting so out of whack for one particular sector. Energy was the third worst performing sector in the S&P 500 last year. It's been one of the worst performers every single year for the past, maybe 5 to 6 years. So, it's kind of, again, been one of those that's been left for dead, and it's become a really tiny sliver of the S&P 500. So I think that's more the case, as opposed to some fundamental case changing, incredibly in favor of energy.
One thing just to add, and Russell, I did note one of the most important factors people were considering in choosing a broker is the range of products available. We launched a product called Schwab Investing Themes for our international clients last year. It's a really, really cool tool. And if you use that theme, if you have a look at Schwab Investing Themes on the Schwab site, effectively we have over 45 themes in which we've bracketed 25 stocks. And so not sector analysis, but just themes within the companies that are in those lists. Space is one of them. Companies that operate in space exploration is there. And within energy, for example, we have a renewable energy theme. There are others. There's some really cool ones. There's, Chinese online marketplace. There are pets. There's junk food, there's health food, and it's a great way to come up with investing ideas. You can click through those themes and see the lists of companies that operate in those areas. You can buy then fractional shares in those companies if you wanted to, with the minimum of $250. So you buy $10 of each company, or you can take some out. You can choose, you can come out of the themes tool and just look into those companies separately using the rest of the data analysis that we provide. But it's a great way to come up with idea creation. If you are considering something like space, the Schwab Investing Themes portal is a really cool way to find some companies that operate in that world. Well, outside of this world, for example.
That sounds great. Super interesting. Thanks. Despite lots of questions there, I'm not sure what the plan will be to kind of come back to you at a different time, but I'm afraid that's all the time we have today, at least. So thank you, Kevin, Richard, for being here. Please, everyone else, as you leave the event, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in and about future events. Thanks for joining us, and I look forward to seeing you soon. Thanks very much.
Thanks very much.
You guys.